Hello and welcome to the latest in our programmes in which we speak to managers of Baillie Gifford's different investment trusts. Today it's the turn of Monks. I'm pleased to have with us Spencer Adair, lead manager of the £2.5 billion portfolio, who's going to talk about the breadth of growth opportunities his team are finding after a year in which so much attention has gone to artificial intelligence stocks. It's time to meet Spencer. Good afternoon, Spencer. How are you?
I'm very good. How are you doing?
I'm very good, thank you. Very good to see you. Let's start off by remarking that Monks has had a good year. The strong recovery that we saw start at the end of 2023 has continued. Net asset value is up 24% over 12 months, helped by a recent rally after the US election this month. But all this is a short time span, of course. But looking back at the 9 years the trust has been run by the Global Alpha team that you're a part of, how has the approach to growth investing evolved?
Okay, well, good afternoon, everyone. Monks is all about capital growth. We compound your capital as shareholders by investing in companies that have got the ability to grow their own revenue and profits at above average rates of return over the long term. Now, the share prices of those companies will be volatile in the short term, but ultimately will come to reflect the real world business fundamentals over time periods that matter, such as 9 years. Today, there's a team of 3 of us who harness those ideas from right across Baillie Gifford's research teams. And that's a change. So we used to be 3. We then went down to 2 after someone retired, Charles retired. And then this year, earlier this year, Helen Jong formally joined Monks as a decision maker. So we've gone from 3 to 2 to 3. Malcolm and I have worked very closely with Helen as an analyst, as a scout, as a co-fund manager for most of her 16 years at the firm. So I'm delighted that she's joining us formally, and it restores Monks to having 3 decision makers. The portfolio is split fairly evenly between the 3 flavors of growth that we've talked about in the past. That's the stalwarts that compound your way, like MasterCard and Disney, the rapidly growing companies such as the AI beneficiaries or Novo Nordisk and the anti-obesity treatments. And then finally, the cyclical growth capital allocators, such as the infrastructure-related companies. One change is that we are stricter about keeping a balance between the 3. So previously, we'd let quite a lot of flex happen. Now, if one of those buckets moved by more than 10 percentage points in a 12-month period, we stop, we reflect, we go to our risk team. So that's changed and become a bit stricter. The underlying kind of theme across the portfolio is superior delivered earnings growth over time. We embrace companies across the globe. I'd love to have a stock in every continent if possible. We're looking for growth to be delivered in different ways. And that creates a smoother result, but it also helps us look beyond where others are looking exclusively. It helps us get beyond the obvious. So some things which have changed there, we're always using data. We're always trying to improve our process. So you'll never expect the philosophy remains unchanged. The process always gets tweaked and improved. We used to have 4 flavors of growth. The data said 1 didn't work, so now we've got 3. We used to have a fairly loose plan for every single holding. Now we've got more detailed, and I think we're tougher, less forgiving on companies that are not delivering. And the converse of that is we're being happier to trim back, even when companies are working, but if valuations are a bit ahead of our degree of insight, we're happy to trim back even if the fundamentals are still okay. And then we've got a deeper integration of data tools and at the point of dealing and for ongoing portfolio challenge, we slightly outsourced that in the past to a risk team. Now the fund managers are kind of taking responsibility for that's in the center. So those are some of the changes. The other perhaps part to mention is that we have a strategic use of gearing. So we're about 8.5% geared at the moment. We want to get to about 10 over time. But that gearing is very, very low cost. We've locked in debts. The average cost is 3%, and the longest dated debt we have is locked in at 1.8%. So that's a great advantage, which as rates are higher, that wasn't an advantage when rates are low, it's become a much bigger advantage now. And we're using that debt in order to grow the fund faster. And we're buying back shares aggressively if we're trading at a discount. So Over the last 3 years, we've bought back approximately 20% of the trust, and that is very NAV accretive. So that's some of the things which haven't changed and some of the things which have changed.
Brilliant. That's really interesting to hear how some things stay the same, but some things are evolving as time goes by. Perhaps let me start with the obvious then. How is the portfolio positioned to benefit from the growth of AI? At your financial year end in April, you reported 10% holding to semiconductor manufacturers and suppliers like NVIDIA, TSMC, but also Texas, Samsung, and ASM International. Has that increased, I wondered?
Yeah, absolutely. Look, we're just about to report some new figures. We've just had our half year end, so these will all be updated. So I won't be too specific, if you don't mind, because we haven't publicly announced them yet. But if I go back in time 2 or 3 years, during the post-COVID slump, a lot of semiconductors were on their backs. A lot of these stocks were not doing very well, and we were really quite aggressive. We had 2 holdings. And as you say, today we've got over 10%. We've moved from 2 holdings to 7 holdings. So this has been an area of really active deployment of capital. If we find companies that we like, that are out of favor, that we think the structural growth is intact, then we are going to buy, and we're going to buy aggressively. And that's what we have been doing over the last couple of years. AI accelerates things here, but it's not the only driver. Helen, who I mentioned in the previous question, has written a good piece, I think, on it's called Beyond NVIDIA, and it talks about semiconductors. That's on our website, and so if you want somewhere to go, that's a good introduction how we think about this broader area. The semiconductors are changing really, really rapidly. They are becoming the scale of these of companies, and what's happening here is really is really staggering. So I think 1.1 trillion chips are sold each year. So it's not just the chip. People think of semiconductors and they think it's the devices that we're talking to. It's really high end stuff. These are in your washing machine. They're in your car. They're in your microwave. Semiconductors are everywhere. So 1.1 trillion. I think that means there's 140 chips for every person on the planet. If you look at and in the West we've got more than that. So we are absolutely surrounded by chips. And historically, Moore's law has meant that transistors, which are these tiny little switches that can turn on and off billions of times a second, that was doubling approximately every 18 months. And so if I go back to the peak of the computer, the CPU market, central processing unit market, the computer's brains improved 100-fold over a 10-year period. Incredible growth. But if I look at GPUs, which is the things that NVIDIA makes, it's the graphic processing units, these are really good at AI tasks. Approximately, they've risen 1,000-fold in terms of performance over the last 8 years. So if we thought things were going fast before with computers, they are growing much, much faster with AI. And that is the fundamental basis why AI has taken off in lots of different directions. The ability to process and the cost of processing has radically changed. And that's the seismic. NVIDIA, all of the growth in AI is based essentially on this foundation of structural advances in semiconductor manufacturing. And that's critical.
Okay. So that's the semiconductors, Spencer. Where else is this, as you say, very broad theme, AI theme, taking you?
Look, we're looking for bottlenecks. And so we're looking for the big bottlenecks are, can you actually make the chips? And it is increasingly hard to do this at scale. My personal favorite company in this whole area is the Taiwanese semiconductor manufacturing company, and it does exactly what it says on the tin and where it does it on the tin. So you can work out what that company does. It is one of the core bottlenecks for growth, and it's increasingly competitors just are falling over because they cannot make these things. So the latest NVIDIA chips have got 208 billion transistors on each chip. 208 billion. That's the complexity of manufacturing something like that is just it costs many tens of billions of dollars to set up, and competitors have been slowly dropping out decade after decade, leaving TSMC as really dominant in this area. So that would be one. We also look at some of the physical constraints of actually building the data centers. It's not just chips. It's, can you get a skilled labor for putting in air conditioning? Can you get the electrical attached up to the grid? So two of our holdings there would be Eaton in the US and Comfort Systems from Texas. And they provide electrical engineering and air conditioning and installation. And their order books have blown out because of a lot of this investment that's required. So it's really broad, and it's not just focused on chips. And then finally, it's the companies that have got the data that are thriving. So it's the likes of Microsoft that has got all the data, or Meta. So these are some of the areas which it's either the bottlenecks or data, some of the core manufacturing, building, and some of the core chips. Those are the three areas that we're really seeing demand really inflect upwards.
Okay, thank you. It's not all about AI, of course, Spencer, but and you say you're pursuing a broad range of growth themes. Could I just ask you about one of those to start off with? You're enthusiastic about the long-term opportunity in infrastructure replacement and renewal in the US. We've heard a bit about that over the past couple of years, but where are we at with that?
Look, I am a terrible dinner party guest because I get super excited about gravel and cement and things like that, and it just, you can see people kind of glaze over. I think that we're at a real tipping point for infrastructure in the West broadly. I'll primarily talk about America, but we can, it equally applies to the UK and to Europe. But before we even get there, companies like Martin Marietta have whose gravel aggregates, they have delivered a 15-fold total return over the last 20 years. I think infrastructure is in a way people think it's a bit boring because if it works, it's invisible. The roads are there. You flick a switch and the light comes on. You turn a tap and the water comes out. But now about 14% of Monks is invested in companies that bash metal, that pour concrete, that install heating and air conditioning, that sell big wooden telegraph poles that hold up the grid. Our companies are quarrying, they're building, they're digging, they're sawing. It's grubby, it's heavy. But amongst all that grubbiness, we believe there's pure gold in there, because you've had 25 years more, 40, 50 years of falling infrastructure spending and lack of maintenance. In the 60s, we used to spend 2.5% of GDP on infrastructure. It's now 1%. And so there's a huge mismatch. We're beginning to see things fail, sadly. Half of all clean water in America, this is treated water, gets lost in leaks. We know all about the water scandals in the UK. I mean, these companies have not invested heavily enough, and we think they have to radically change. On top of that, climate change is coming along. You have the big storms, and you've got flooding, and again, companies and the countryside is not coping with this. And so, if there was no climate change, we'd have to spend a lot. But with climate change, we have to spend even more to get ourselves ready. And then finally, America in particular is in competition with China, and so it is trying to onshore some of the really big industries. It's getting more manufacturing onshore, and it is fallen behind a bit in that degree of domestic manufacturing, and so it's catching up. So I put all that together. The American kind of civil engineering society thinks America needs to spend $5 trillion of capex to get up to speed. Currently, American infrastructure is rated C-. Like, that is awful. But they're trying to get it up to somewhere which is adequate. They have to spend $5 trillion, and there's currently plans in place. Albeit we've got a new president, so things will change. But there's currently plans in place to spend about $2 trillion. Now, $2 trillion in today's dollars is the same as 14 Marshall Plans, where we rebuilt Europe after World War II, and that's converting $1945 into 2024 dollars. This is a massive amount of spending that's coming, and it's not even half of what they need to do. So that's really exciting for us. So that's the demand side. On the supply side, you've had a number of companies that have been existing on crumbs and therefore have consolidated their industry, because there's been nobody wants to set up a new gravel pit or a new cement kiln or a new pool treating facility. And so many of these companies are really very dominant in what they do. So we've got a drainage company, Advanced Drainage Systems. That's sexy. That company's got 50% market share in big plastic storm drains in North America. Absolutely dominant. We have a company in Canada called Stella Jones, which makes the really long poles that hold up the grid, the telegraph poles. It's got about 50% market share. So we're finding this growth is exciting, but we're finding it in bottlenecks where there's no supply side expansion and where companies have waited years, if not decades, consolidating the industry, getting ready for this surprise. And when that comes, my goodness, I think it's going to be incredible for shareholders.
That sounds truly enormous. You've referred to Trump there. I mean, what might the impact be of his administration? Is he going to do even more of it, or cut back?
Look, nobody knows exactly what Mr. Trump has on his mind. He likes doing deals. And he's shown an ability to change his mind depending on what's in front of him. So I think it's pretty hard to work out exactly what he wants to do. He has talked an awful lot about reshoring manufacturing onto North America. That would be very good for this. I think there are. We have to think through global supply chains. We have to think through defense, international trade, energy policies. There's lots of things which are at play here. Very narrowly, I can look at what's performed well since his election, and it's quite a lot of the infrastructure companies, Martin Marietta's, the advanced drainage that I talked about, Builders First Source. So the near-term market reaction is positive, suggesting that people think that this will at least continue. He will definitely repeal some of the Inflation Reduction Act, but only part, not everything, perhaps. We think infrastructure spending has to rise, irrespective of who's in the White House. Republican states in general do better out of some of these plans. So locals want better roads. They want better dams. They do not want their bridges falling down. So there's some very strong local activism there, and I think this competitive piece with China is really critical. I don't think he's going to want to do anything which really hurts US onshore manufacturing. So I think there's going to be some changes, definitely, but I think, broadly speaking, that there is a big problem, and that America has to address.
Well, more broadly than infrastructure, though, Spencer, you referred to, what about the impact of tariffs that he's talked a lot about against China, which then could have knock-on consequences around the world? How is your portfolio prepared for that, or affected by that?
So we've been preparing. We've been preparing for a bipolar or a slightly deglobalized world for about 3 years. We've been pretty active in what we've been doing. One little stat here: I think that if you look at our revenue across the whole portfolio, the amount of revenue that's Chinese companies selling into America is under 1%. So we have tried to de-risk that as much as we possibly could. In the last year, I've been particularly active in looking at our Western companies that sell into China and saying, like, where are the companies that we need China to thrive, or they need China sales to thrive in order to meet their long-term targets, to meet the plans that we've got for each company. And frankly, I've been selling the likes of Adidas, the German apparel maker, shoemaker, Pernod Ricard, Tesla even. So there are Western companies that are active in China that we have said, okay, the market's been really good at pricing in the risk for Chinese companies really quickly. I think it's been quite slow to price in the risk for Western companies selling into China, and therefore we've been taking capital away from those kind of exporters that depend on Chinese demand.
Okay. You mentioned Tesla, and so we're talking about the aftermath of the US election. We can't ignore the presence of Elon Musk in helping Donald Trump get returned to the White House. Tesla shares, as you know, are up 41% since the results. Do you regret selling the small holding you had?
Oh, perfect. The perfect hindsight question. Of course. Look, Tesla, let me put this into context. Roughly speaking, I don't have the exact numbers in front of me, but roughly speaking, our shareholders have a return of something like 80-fold from their holding in Tesla. So it has been one of our it's been an extraordinary investment and added an awful lot of value. If I had not touched that holding, it would have been well over half of Monk's, right? It would have been a huge, but we have consistently trimmed and reduced back. We have been waiting for a couple of reasons. One, we have been waiting for competition, and competition in the West has taken longer to appear than I thought. By now, I thought the likes of Mercedes and BMW and Volkswagen would be primarily electric. They're still early in making that switch, so that's been much slower than we expected. The Chinese manufacturers, though, have been much faster, much faster. I mean, and they provide significant challenge because suddenly it means Tesla's opportunity growth is not perhaps fully global, but it's probably going to be more limited to, at the moment, the North America, Europe, and currently China. It's going to be harder for Tesla to grow in the likes of Africa and Brazil and other places where Chinese EVs or electric vehicles will be supplied. So there has been a shrinkage of the potential there for Tesla. And Mr. Musk and Mr. Trump are remarkably successful, but they're definitely quite big on the ego. And so it wouldn't entirely surprise me that they're currently chums, but who knows? Those are two big personalities in the same room, and they've both got a record of falling out with people. So let's see, how long the chumminess lasts for. So look, we sold because we saw we had fears around competition, and we had fears around competition primarily in electric vehicles, and ultimately, if there was to be some kind of retaliatory tariffs, you could see that actually a tariff around Tesla gets right to the heart of this administration. So there's a greater risk of politics interfering with economics.
I see. Well, while we're talking about Musk, you've got a small weighting in SpaceX as well. That's reportedly seen its valuation go up to $250 billion. Are you excited by its prospects?
I'm much more excited about SpaceX. So SpaceX holding, we've got a direct holding, you're right, it's unlisted. And it's the largest holding in the Schiehallion fund. So it's about roughly 10% of that fund. So together, that's just over 0.5% of Monk's is in SpaceX, if I combine those two. So that's the context. Unlike electric vehicles, the competitive position has got stronger at SpaceX. If anything, there is, his gap over the company's gap over competitors has got broader, not narrower. So we don't have that extra question mark, and the valuation can largely be accounted for by the communication network, that Starlink that he set up, and you've also got then the space business in there as well. So very excited by that. I think it's if that was a listed company, it would be one of the largest in the world. It is still growing. I would actually like it to remain private for as long as possible, but that's not always what we have there. And I think it's great. It's a great example of backing an early company that's taking really huge engineering risks in order to build something physical and tangible, and that it is getting there. It's reached its own kind of terminal velocity of funding, etc. And that's really exciting for it. So very excited about SpaceX.
Okay. Last question on Musk, but not my last question. But I mean, if he can stay on good terms with the incoming president, how does Musk run these businesses and the new Department for Government Efficiency that he's been given? Has he got good teams around him?
He does. If you add in Twitter, if you add in, XAI, there's like he's doing a lot. His brain thrives on having difficult challenges and multiple challenges. He has got very good teams running Tesla and SpaceX. Tesla and SpaceX. I don't know the team running Twitter very well. That's not. We haven't invested there. I think he will be quite. I think he will obviously have to get quite a lot of advisors around him for the Department of Government Efficiency. I think that's probably a task that's easier to be bombastic at the beginning. Whenever you get down to the detail, that's going to be a real headache to try to do what he wants to do there. It's radical. I just think there's an awful lot of vested interest that will push back against some of this, but who knows? Yeah,
digital payments, Spencer. It's another growing theme within the portfolio. Can you tell us about some of the holdings and what you find exciting about them?
Lots of holdings, and basically we're saying that we're going to continue to shift away from cash and away from physical cards into more digital forms of payment. They tend to be more secure. They tend to have network effects around them. The largest processors can do things cheaper, which gets more volumes, etc. So we tend to have a network effect, which leads to really great economics. And we're beginning to see other data businesses being built on top. If you know what people are spending their money on, that's an extremely valuable node to sit on in terms of data and insight, and therefore you can do lots of interesting things there. So we've got around 4% invested in directly in digital payments. Mastercard, which is a long-term compounder, would be part of the infrastructure, part of the rails of how payments are made in the West. But we've got more rapidly growing companies such as Block and Adyen. They serve different parts of the digital payment space, so individuals versus enterprises. Block and Adyen have also both taken slightly more sober approaches to controlling costs. And so their share prices have been really strong because you've had continued structural growth, but you've also had that being boosted by some cost cutting and as well. So you've had a double kicker to profit. That double kicker does not last forever, but it's definitely a welcome form of discipline. And then finally, we have a private holding in Stripe, about 50 basis points see-through when I look at both Schiehallion and direct holdings. So we like these businesses. They're growing. They may create the network type businesses. It reminds me a little bit of whenever people started thinking about user data type network effects way back for the likes of Facebook and Google, etc. And so we're excited about where they can get to, and it feels very early in that journey across most of those names.
You've got 61% in North America, and you've got 4 of the Magnificent Seven in your top holdings. What examples of innovative growth can you tell us about outside the US?
Innovative growth outside the US.
Yeah, exactly. I think a lot of the companies we're talking about are in the US, not all of them, but any more from who are non-US growth stories?
Yeah, a couple. Lots, not a couple, a lot. I'll give you a couple, and then we can. But I'm open to everything in the portfolio is growing structurally in an interesting way. The really innovative stuff would be Novo Nordisk, the Danish healthcare giant. Now, it led the way in insulin and diabetes treatments for years. It invested really heavily at a time when no one else was investing, and it pioneered a new class of drugs called the GLP-1s alongside Eli Lilly. The brand names here would be Wegovy and Ozempic. You've seen them, commented on, I'm sure. They've built up 10 years of data, primarily treating type 2 diabetics. And so they've got about 10 million patients that they've treated with these drugs. So they've got a really rich data source that they can talk about how effective these things are, what other conditions improve, what are the side effects. Now we're seeing a sharp acceleration in growth because these drugs don't just treat people with diabetes. they appear to cause the obese population to lose between 20 and 25% of their body weight and have a really big impact. Again, roughly a quarter reduction in the risk of death, in the risk of heart attacks, strokes, cancers, even dementia. This is as close to a kind of a longevity pill or injection that I've seen. It's a really big impact on people's health outcomes. Now, some of that data is still coming through, but very few others, very few others have got the depth and the time series that Novo has. So that's really critical. So rather than the 10 million people that are taking these drugs today, it's possible that this could be hundreds of millions of people taking the drug. I mean, there's roughly 1 billion obese people globally. I think what people often get wrong is that these drugs will not be just taken to have a reduction in the weight. You'll be on these drugs. These drugs are similar drugs for the rest of your life to control and keep your weight at a low level. It's a little bit like high blood pressure tablets in the 70s when they first came out, and people were taking diuretics, and it was to reduce your blood pressure. But ultimately, if you start taking blood pressure tablets, you take them for a long time because you want to keep your blood pressure low. And so I think the scale at Novo, the innovation that's been going on for decades, the data edge that they have, the manufacturing edge, the duration of treatment, the strength of the brands, all of that is really underpriced in a very strong innovative company from Europe. Switching gears a little bit, Mercado Libre, which is the Brazilian, South American e-commerce and fintech leader. It's also got a payments business, which I should have mentioned in the previous question, which is why I came back to me. It has compounded its growth rates at 40% per annum in dollars over the past decade. So 40% per year in dollars over a decade. And that's despite extremely difficult politics. Near economic collapse, very high inflation. So if you think, what's Mr. Trump going to do? Well, these guys have lived through Argentina and Brazil, and they've managed to produce structural growth in dollars. And they've also taken on and defeated Amazon, by the way, which not an insubstantial company. So I would rate the team and the ambition at Mercado Libre and their ability to innovate as being at the very, very top globally.
Okay, Spencer, two great examples. No, that sounds like a proper growth story. Going back to the team that you talked about at the beginning, what is the division of labour between the three of you?
One person, one vote. We are all generalists. We look at the whole portfolio. We've got different personality types. We've got different educations. So we're very different individuals, and I think different bits excite and stress us at different times, but that's the beauty of it. So we do not divide the world up and say this is Malcolm's bit, this is Helen's, this is Spencer's. We take all decisions equally, one person, one vote, and we make better decisions as a three than I would ever make as an individual.
Okay, so if two people like something and one person doesn't, it happens.
Correct. So there's always a majority.
Yeah.
We can move quickly if we need to. I remember the day that ChatGPT-4 was announced, which is the AI product. We sat down and we looked at the first demonstration, and all three of us went, "This is terrible for Chegg, one of our holdings, terrible." And we had the deal on within 30 minutes of seeing that demonstration. So if we need to act, if something, we're long-term investors, but as being long-term, if things change, we can act very, very quickly, and we're not caught up by one person being the expert that has to write and have a view. We can be nimble if we need to be.
Okay, brilliant. I've got a question here about performance. As I was saying, this year is in a recovery. Previous 2 years were more difficult, particularly 2022. So I've got a viewer who's wondering whether there's a connection with the merger that Monks did with the Independent Investment Trust, and whether that, was that an element of indigestion going on there, absorbing that portfolio that has maybe weighed on performance?
No. The majority of the assets from the independent that we merged with came in the form of cash, and we deployed that cash into either buybacks or buying fresh ideas. We did not inherit anything that we did not want and was a drag on performance. So that's not the case. I would say it was more that growth investing fell out of favor. It was very much in favor in 21, and it fell out of favor in 22. And it took us a while. It took us a while to get over that. We've got the portfolio in balance today, so it's a third in each of the three growth buckets. We've produced now strong absolute returns over the last 12 months. We will not always produce 25-ish% growth in NAV every year, but that's recovery. I think things bottomed roughly 12 months ago. I do not know why. I cannot explain it fully. But it feels like we turned the corner. NAV growth has been remarkably strong now for a while. And we're actually, last week, I haven't checked today, but last week we were getting close to our all-time high in terms of NAV per share. So I think we were within 5 or 6% of that peak. The share price has not fully recovered because we've gone from trading at a premium to a discount, and that's why the buybacks are helping. So actually, this feels like we're through the worst of it. We're producing good results. It's nothing to do with the independent.
Okay, yeah, a kind of a coincidence there rather than a cause. But talking about the share price, that's interesting what you're saying about the portfolio asset value being at a high. The shares aren't, and they're trading at 11% discount. Today or yesterday anyway. How can the discount best be tackled? There are buybacks going on. I mean, the trust was a big issue of shares in the past, is now buying them back fairly consistently, I think. Is that the best way of doing it?
Yeah, consistently and aggressive. So the very best way to get your discount to close is to have strong NAV growth, which attracts new savers and encourages those who have saved with you to stay. So the best way to do this is to get your performance going and to get absolute growth. So both relative and absolute growth. That's what's required. That's what we're working on. That's the task. The second way is to be consistent and clear in your capital allocation. We will keep, so the board and the managers will keep buying back shares aggressively if we are at a discount. We have bought back 20% of the trust in the last 2 to 3 years. That is as high as many. That is right up there in terms of how aggressive we've been. We've done it consistently. This is not lumpy. We're not trying to time it. We're just, and eventually people will realize that we're serious about this, and we'll keep buying. And you eventually shake all of any loose holders that are still there. We do not want big swings in our net asset discount to share price. We will issue if we're at a premium. We'll buy back at a discount. I will keep repeating that and repeating it, and I'll keep. You can check my actions, and that is adding value for existing shareholders and keeping trying to support the share price as much as we can.
Now, what are the key differences between the investment strategies of Monks and Scottish Mortgage?
So I guess they're sister trusts in a way. So one difference would be scale. Scottish Mortgage is several times larger than Monks. One difference would be around concentration. We've got more holdings. We're less concentrated. Our larger holdings tend to be 4% of the trust, not 8-9% that they would be at Scottish Mortgage. So more diversified and smaller absolute holdings. One difference would be around definitions of growth. Scottish Mortgage have got vast majority of their portfolio in the disruptors, the really rapid growth stuff. They produce fantastic returns. They are more volatile, but they produce fantastic returns overall. Our definition of growth is broader. We've got the steadier companies and the more cyclical companies as well. So we've got that balanced out. And then finally, there is a difference when it comes to private company enthusiasm. We have got just between 4 and 5% in unlisted companies, and the majority of that is in another investment trust that invests in unlisted companies. So we've been a little less. We've been a little slower to adopt, or a little less aggressive in adopting some of the private companies. We're cherry picking ones that we like, but we're happy to do that slowly, progressively, and build up the unlisted weight over time. We're in no rush. So we have a 10% limit there. So hopefully that's the difference is. There's no right or wrong answer to that stuff. It's just you try to outline them, and then shareholders can choose the ones they feel most comfortable with.
Yep, no, they are doing different things, or different parts of the same spectrum. Turning back to the USA, where we're talking about tariffs, the impact of tariffs. You hold small and medium-sized companies in the portfolio. With the fact of tariffs and a kind of "Make America Great" kind of approach, the smaller cap and medium-sized stocks in the US have been going up since the election. Is that an area, domestically focused stocks? Is that an area that you're interested in?
Yeah, we've been thinking heavily about domestic stocks. We own several: Eaton and Comfort and Stella, the Jones, the ones I've talked about on this call. We're continuing to look. Generally speaking, we're looking for businesses that are kind of local champions that can really thrive. So if we're looking at a company in China, it's a company that can thrive in China. If we're looking at a company in Brazil, it's a company that can thrive there. So we're more. 10 years ago, 9 years ago, we would have been very keen on globalization, companies that can really dominate the world. We're now keener on companies that can dominate their area, and you can define that geopolitically broadly. So yes, small, not necessarily small caps for the sake of being small, but focused on one geographic area, absolutely.
Okay, and following on from that, not focused just on the US, but what is the smallest company you can effectively invest in? Any examples of small caps in the portfolio? Yeah,
so so historically we've invested in companies down to £100 million market cap. A 0.5% holding, which would be the smallest I'd want to take, would be about £12 million. And so, I wouldn't want to become a dominant shareholder in any company. So say 100 to 120 million would be a 10 to 13, 14% holding in the company. So we can go down that. We can, and we have gone down that low in the past. It would have to be an exceptional company, because once you own 10% of it, you're slightly locking yourself in. So if you're going to do that, you're going to be really sure in your enthusiasm and what you want to do.
Well, on a similar point, but turning back to SpaceX, SpaceX is held by a number of trusts at Baillie Gifford. How are these balanced to avoid over-concentration?
Well, firstly, it is a huge company now, SpaceX. So our proportion of the underlying company is really very small. And as I said, I look at my see-through holdings through both the direct holdings and other holdings, and it's about 0.5% amongst. So I think from an absolute proportion of the company we own and from a portion of the trust, there's no problem. We're monitoring that kind of stuff for all of our companies all the time. We've got a centralized dealing desk, and who will limit the amount that we have in the amount of equity we hold in any one company. I really value the ability to reverse if I make a mistake. I want to know where the exit is. If I'm sitting in a room, I want to know where I can get out the door. And so for every company, I have a plan of why I hold it, why we hold it, and what the actions we need to see. But I also need to know that I can sell it on a dime if things change, or if I'm disappointed, or if management changes. And so for every company, I buy it with a size knowing that I could sell it really quickly if I needed to. So the largest companies in the trust today, if you look at the top, they are really big, really liquid. It's the likes of Microsoft, it's Nvidia. Those companies, I could sell that entire stake in about 2 minutes. Honestly, it's that form of, I will not get us stuck into very illiquid things. That's not my style. If it is quite an illiquid company, it will be a small holding.
Yeah, that's reassuring. Okay, last question, Spencer. After the strong year you've had at Monks, do you think we are seeing a broadening in stock market returns? And what is your outlook for the future?
It is unusual that we've had the Magnificent Seven being quite so dominant in share price returns the last few years. It feels to me that things are beginning to broaden. That is great, because Monks is designed to capture growth, a broad type of growth. So I don't like it if it's narrow in any one area. Even though we've had some of these big holdings, it didn't feel good to just be dominated by one thing. So we've got AI, we've got infrastructure, we've got rising income levels in certain developing markets. We've got GLP-1s, we've got digital payments. We've got a lot of different drivers here. When I look at the holdings through the risk model lenses, our companies are growing their revenues twice as fast as the market average. They're growing earnings about a third faster than the market average. They've got very strong balance sheets. They are investing more in R&D and advertising than others, so they're trying to grow faster. And yet the valuation premium we're paying is about 20% compared to the average. I don't remember as favorable a forecast growth, ambition take, balance sheet take, and valuation being in line with what historically we paid. That feels really exciting to me. So we're really confident in the portfolio's ability to deliver from here because of the summation of all of those different kind of growth rates that we're seeing. Individual companies will always do better and worse than you think, but if the average comes in where we think it will, then we will continue to have really superior growth, certainly for the next 3 years, which is about as far as consensus will forecast out.
Okay, Spencer, thank you very much. That's an encouraging note at which to end. I'm afraid that's all we've got time for, but so look out for more programmes about Baillie Gifford Trust in the future. If you want a further update on Monks, they've got half-year results, I believe, next month, so look out for those as well. But in the meantime, thank you very much to Spencer for his time, and thank you for joining us, and good afternoon.